Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. Today, we're extremely excited to have you with us. We're going to talk about what's happening right now in the commercial real estate market, especially as it relates to multifamily. We've had a change in conditions a little bit, and so we probably want to get an update on how the markets are responding to the increasing interest rate. Today, we're very, very happy to have a return guest, Mr. Tyler Bynum, who's with Worldwide Commercial. You might recall that he's come on our show before talking about the best way to acquire multifamily. But now we're going to talk about the impact of changing conditions as it relates to multifamily and how buyers and sellers are responding to that. Welcome to our show, Tyler.
Thanks for having me.
Yeah. So things are a bit different since the last time we got together. I think the first time you came on our show, cap rates were, some cases 4%, 4.5%. Now people are begging for a 5.5 or 6 cap to get a deal done. What are you seeing from your perspective as a broker who's assisting folks in buying these properties or selling these properties? What are the main issues that you're seeing that buyers and sellers are experiencing right now?
Right now, and as a broker, to get a deal done across the finish line, there's no lack of buyers in the market right now. There's tons of people that want a deal. They want to get a deal done. But we're seeing probably a 10% gap right now compared to what sellers are wanting to sell their property at and what buyers are willing to pay. And that has probably a lot to do with all kinds of different aspects that we'll probably talk about today. But that 10% gap is the hardest deterrent of getting a deal done right now, is trying to figure out, is the buyer going to come up or is the seller going to come down, or is there a meet in the middle situation? And as a broker, that's the hardest part to get around to get something closed right now. Yeah,
and I would imagine both buyers and sellers have their own set of complexities that they have to contend with. One, on the buying side, they can't get the cheap capital like they used to be able to get. And so therefore, they can't afford to pay those aggressive cap rates anymore. Is that what you're finding?
Yeah. And even just on a cash flow basis, right? Once they close on that deal, the cash flow has been getting hurt on because of these interest rates and rising expenses. And, they, in the past, maybe they were underwriting to trying to get a 5 or 6% cash on cash return right off the bat. But, now they almost have to ease into that. And maybe that property won't cash flow right off the bat anymore. So they got to get a little bit more conservative with their pricing.
So what are you seeing in terms of valuation on these assets? Are cap rates, we know interest rates have rapidly increased, but are cap rates increasing at the same rate, or are they a little slower?
I'd say they're slower.
Okay.
Right. Well, I think a lot of the buyers don't want them to be that slow anymore, right? They want them to increase the same rates. But the problem is it's a market, right? And so it's the property's worth what someone technically is willing to pay for it. And there still is a lot of money sitting on the sidelines and a lot of buyers that want deals. So there's buyers out there that are still maybe getting a little aggressive. So those cap rates are slow, not growing as fast as enough because, as a broker, if I'm representing a seller, my job is to get the highest price possible. So you got to start at that high point and work your way down sometimes. But right now cap rates haven't increased that much, but they're I feel like in the last couple of weeks we're starting to see them soften.
Okay, starting to go a little bit. But prices on assets are going down because we have rising expenses. Is something you mentioned.
Yeah.
Well, what's happening with that?
Yeah. A lot of people are pointing fingers, right? I mean, interest rates all over the news, right? So when a lot of people are saying it's interest rates are the issue, which obviously is a big issue. But another huge factor that people are starting to realize is, insurance, salaries, and property taxes, in my opinion, almost have a bigger effect than interest rates right now, just because your insurance cost is above the line, so that's a direct hit to your NOI. The interest rate's below the line, so you can get creative on your water flow distributions on maybe how to get around that a little bit. But when it's a direct hit to the NOI, that directly affects the property value. So.
So you got insurance, property tax, what we call top of the line or expenses. And then we have, you mentioned salary, wages. Are you seeing increases with the property management fees, or are they pretty settled?
Fees I've seen kind of stagnant or even lighten up just because they're trying to make the deals pencil. But those property management employees, right, the maintenance guys and the managers and stuff, they need to be paid more money because due to inflation. So, which I would say is a valid argument right now with expenses going up across the world. So a lot of people need to get paid a little bit more, and it's increasing the property expenses.
So now, do you feel that the current owners who are operating these properties, they're facing all this pressure with rising expenses? You're not able to sell an asset as fast as you wanted to, so you're having to hold on to it a little longer. What impact do you think that's going to have on rents? And then at what point where you're not able to raise rents anymore?
Yeah, I think that's the big question right now. A lot of people, the unforeseen question in the past was interest rate and cap rates. Well, now that's starting to kind of get figured out. Well, now the unforeseen is the rents. A lot of people are saying rents are going to kind of level off through this recession that we're heading into. So the rents aren't going to grow as fast as they were.
But how is that possible if the expenses are growing?
That's going to be the tough.
The people that are saying that are not economic people. They're just kind of like, I don't know how that math works. If your expenses go up,
rents got to go up.
If your expenses go up, your mortgage payment goes up. How can rents go down?
Yep. It's going to be one of those things that I think we're well protected here in Texas with that aspect. We're still in a pretty big supply and demand issue here. So I think the owners
we can
here
absorb the higher rents here. Yeah, because when you compare rents here in Texas, Dallas, Fort Worth, to the rents that people who are moving here from California and some of the gateway cities,
there's still a lot of room there.
There's still a lot of room there.
Yeah, like if you're a Dallas resident, maybe you're seeing that rent grow at 2-3%, and you're like, how is my rent being pushed right now? Well, the people from moving here from New York, California, and the in-migration here, it's still cheap for them. Right. So those rents are still getting absorbed, like you're saying. So I think that's why we're a little bit more protected here. I know some sellers that are hurting and struggling right now trying to navigate this market, but they're not hurting as bad as the guys on the coast.
Right.
So
it's got to be so now we talked about it from really the owner, operator, seller side, the struggles they're having with the increasing expenses. On the buyer side, they don't have as free access to capital as they did before. But what about those institutional buyers who their advantage has always been large pockets of liquidity? Is this a great time for them to get into the market and get assets at a good price?
Yeah, I think so. I mean, if you watch institutions the past probably year and a half, right? Last year when the market was hot, the people winning deals, the buyers winning deals was more private syndicators and private money, but the institution money was kind of sitting on the sidelines. I think, they probably had a little bit of a crystal ball and kind of knew where we were headed. So that institutional money is starting to get deployed now. You're seeing large funds go out there and starting to try to take up larger portfolio transactions. But they're not going to overpay for those prices.
Right.
The institutions, they're sitting back, or they were sitting back. They're ready to go. But a lot of these kind of sellers are thinking that, that magical institution is just going to come and overpay for my property, and they got a lot of analysts, they got a lot of data. They're not
Mhm.
going to overpay for these deals.
Right.
You know, they want to buy deals, but they're going to be cautious about buying.
Right. And when you move out the, some of those smaller groups, there's more room for them to come in, and they have more negotiating power because they can close quicker.
Yeah.
And that's really becoming a thing, because I think we're finding that some owners are facing more pressure because they had those transitional loans, those bridge loans that were, not fixed rate but variable rate loans. And they're having to sell faster than they want to just to get out of that loan. Have you found that to be the case?
Oh, yeah. I think, news broke a couple weeks ago. It's probably one of the biggest foreclosures ever to hit Texas. But that was that exact scenario, right? Their bridge loan was coming due. They were already kind of struggling servicing the debt before their cap rate expired, right? So then once their loan expired and they got bumped up to interest rates and they weren't servicing it previously, it put that pressure. Same thing, if your insurance contract expiring and you were paying $800 a door and now it's going up to $1,300 or whatever that might be, you're right. The sellers have a more defined timeline on when they need to get rid of that property, or they need to raise more capital, like you said, and decide I'm going to hold this longer. So that's what we're seeing. It's either maybe a pull the trigger now and you don't really get the returns that you were promising or needed at the moment, or you can go raise more money and increase that hold for maybe a couple more years to, everyone's talking about surviving the 25, right?
Yeah.
Survive the 25 is the phrase right now. So.
Right. Yeah, I mean there are a lot of pressure now. Now we keep hearing about this recession, which is like another whammy. So now we're facing an environment where our expenses are higher, our access to capital is lower or more restrained or constrained, and then if our customer, which are our tenants, if they're being laid off their jobs because of a recession. It makes it hard to raise rents, and then it makes it even more difficult to just keep your thing fully occupied. What are you seeing with regards to that?
I think my opinion, if you're building a portfolio or whatever, I think that's why there's a huge importance of being diversified with the class of assets that you have. Right. When a recession hits, statistically, student housing performs great.
Right.
And
so everybody's going back to school.
Yeah, and military housing and those kind of government funded projects perform great. And then during COVID, Class A properties performed great because the retail blue collar type workers all got laid off or the jobs were shut down. But the white collar guys that were able to work remotely from home got to keep their jobs and be able to pay rent. So, Class A performed through COVID. And then, typically when we head to a recession, they always say B class is the best asset, right? Because it's in the middle ground. And then obviously the student housing as well. So that's why I think it's good to not own just one asset type. It's to be diversified in the portfolio.
And that's very interesting that you bring up that point. Most people don't realize that there is a kind of unspoken subsidy to student housing. And it's really a government subsidy, because when you go to school, people are going to get student loans. They're going to get Pell Grants. They're going to get various means of cash that a portion of that is used to pay their rent in student housing. And so really that student housing project, and then the attendance at these universities go up significantly because of that subsidy. You can work a part-time job and get all of this access from student loans and grants to kind of supplement your lifestyle and go to school. So that's why the enrollment goes up, and that's why student housing tends to better perform during a recession.
Yeah, absolutely. I mean, people get laid off and then figure out maybe that wasn't the path they wanted to go down, and like, I'll just go back to school and get a degree in engineering now, and recalibrate and redirection their life. So it's a great opportunity to do that for the customer, and even as business owners or operators. Down markets is the time to focus on operations and make sure your asset management's in place and your property management's in place. And when times that growth aren't as rapid, it's time to really focus on in-house.
Yeah. So what do you see? You said survive to 25. We know what our reality is now. What do you think our reality is going to be in 25?
I personally think it won't be really a survive to 25. I think they just say that because it rhymes.
Okay.
I think it's going to be more of I think 2024 is going to be where the market we're already starting to see the market, the sellers and the cap rates kind of soften today. They're talking about one more Fed hike in May. That is the talks. It's going to be the last one, and then it's going to level off for a bit. 2024 rates are probably going to start coming down. Who knows about the expenses, right? But probably not going to come down. But that 2024, I think there's going to be a lot more transactions start happening, maybe even towards Q4 of this year is I think when we're going to start seeing that market turn. And so it's mainly a survive to 2024, but I think they just say 25 because it rhymes.
Okay. So if you're talking to folks in our audience and maybe they're part of a syndication group and they own an asset, or they're a developer and they have an asset that they're trying to stabilize, what if there was a recommendation, maybe one or two things that you would recommend for them right now that they could do so that they can be sure and survive to 24 or maybe 25, what would you say?
I think kind of what we just talked about a little bit would be focusing on in-house operations. I mean, your asset management and your property management teams are increasingly important.
Right.
You're not, if growth is slow and you're not acquiring a bunch of deals, really hone in on the assets that you currently own, really get them down, financially operating as best as you possibly can, make sure your loan is being serviced. And if your insurance rate's expiring, you have enough capital in there for that expense boost. So I would think asset management's just extremely important to be able to coach up your property management team and make sure your property is doing well.
Perfect. Tyler Bynum, glad to have you again. Worldwide Financial, his information is on the board. If you're looking to buy a property, sell a property, reach out to him. I know that you have you're working on a little side project where you have a asset management tool coming out. Maybe once that's fully developed, you can come back on the show and tell us about that.
Yeah, I think it's going to be the right time for it. So
yeah, I guarantee you. Asset management is very important. I've learned the hard way. So, but thank you again for being a part of our show. Tyler, thank you for coming out, being a part of our show this time again, and hopefully love to have you back. If you like what we're doing, if you like the content, if you like the information we're providing, be sure and like our episode and even promote it. Send it out to other folks. But most importantly, be sure you subscribe. Again, Charles Williams here, owner and managing member of Pioneer Realty Capital, here again thanking you for being a part of the Capital Playbook.